So today, the Federal Reserve did, well, absolutely nothing. They held interest rates entirely flat. And in response, the stock market panicked, and mortgage rates are now just rocketing higher.
Right. Doing nothing turned out to be the most aggressive action they could actually take.
Exactly. Welcome to our deep dive. Our mission today is to decode the Federal Reserve's latest signals from their recent monetary policy decision. We're taking your sources on this critical Fed meeting, the very first, under the brand new chair, Kevin Warsh, and extracting exactly what this means for your wallet, your personal loans, and, the broader economy.
Because underneath the surface of this decision, there is a massive amount of machinery shifting gears.
Okay, let's unpack this. The Fed kept rates flat today, sure. But if you look at the actual documents and the projections they just released, they are practically shouting from the rooftops that heavy financial pain is coming.
Yeah, it's a lot to digest. Because to the casual observer, right, a pause always looks like a sigh of relief. The immediate assumption is that the pressure on things like credit cards and auto loans is finally stabilizing.
Yeah, you'd naturally think so.
But Wall Street doesn't trade on the current month. I mean, Wall Street trades on the shadow of what is coming in the next 6 to 12 months. The future the Fed just painted in these documents is remarkably strict, and the market is repricing the entire economy based on that strictness.
So let's look at what the market is actually seeing that someone just glancing at a headline definitely missed. As we noted, this was the first meeting of the Federal Open Market Committee under Kevin Warsh. And when the FOMC meets, they release their quarterly summary of economic projections.
Ah, the famous dot plot.
Yes, exactly, the dot plot, where every official plots where they think interest rates need to be. Looking at the breakdown in the sources, out of the 18 officials in that room, 9 of them project the Fed will raise the Fed funds rate by at least a quarter point before the end of 2026.
Which is huge. I mean, having half the committee explicitly putting a future hike on paper is a massive signal. It indicates that the current restrictive rates are not viewed internally as restrictive enough to finish the job. They are basically telling the public that the threshold for inflicting more economic pain is incredibly low right now.
And the financial markets digested that signal instantly. Our sources highlight the CME Group's FedWatch tool, which tracks how markets are betting on future rate movements based on Fed funds futures trading data.
Yeah, the data shift there is wild.
Right. Because yesterday, before this meeting, the market was pricing in a 60% chance of a rate hike by year end. By Wednesday afternoon, within hours of this quote-unquote flat rate decision, that probability rocketed to 85%.
Wow.
Yeah, they held the rate steady, and the market became 85% sure a hike is imminent. It reminds me of a parent counting to 3 for a misbehaving child.
Oh, that's a great way to look at it.
The Fed is the parent. They just said 2. They didn't hand out the punishment today. But that FedWatch tool jumping to 85% is the market suddenly realizing the Fed is taking a very deep, very visible breath to yell 3 before the year is out.
Yeah, the punishment is basically priced into the behavior before the number is even spoken.
Exactly.
And what's fascinating here is how deliberate that expectation management has become in modern central banking. I mean, surprising the market is viewed as a cardinal sin because surprises trigger panic, and panic triggers liquidity crises.
And nobody wants a panic.
Right. So by utilizing the dot plot and strategic leaks, the Fed effectively prices in the reality of an upcoming rate hike before they actually pull the trigger. By the time the hike is officially announced, the market has already adjusted asset prices to reflect it.
So the stock market dip playing out today is the market prepaying the emotional and financial toll of a hike so they don't have to absorb a catastrophic shock later.
Exactly.
That brings us to the core issue, though. Why are they threatening to yell 3 at all? I mean, the Fed's stated holy grail for annual inflation is 2%. But according to the internal projections we are reviewing from your sources, their view on the current inflationary environment has drastically shifted.
Drastically.
Yeah, Fed officials are now expecting PCE inflation, which is their preferred gauge for consumer costs, to average 3.6% by the end of the year.
And that 3.6% figure is really the elephant in the room here. It is nearly a full percentage point higher than their last projection back in March.
That's a massive jump for just one quarter.
It is. In the context of central banking, a 1% jump in your baseline projection over a single quarter indicates that inflation is not just lingering. It's becoming deeply entrenched in the structural pipes of the economy.
And the sources point to a very specific root cause driving this stubbornness, which is the energy crunch resulting from the Iran war. The conflict is bottlenecking global energy supplies,
No,
sending shockwaves through the cost of shipping, manufacturing, heating, all of it.
everything runs on energy.
But let's look at the actual mechanism here, because this is where I have to push back a little.
Okay.
The Fed is completely helpless on the supply side. I mean, they cannot end a war in the Middle East, they cannot put more crude oil on tankers, and they cannot refine gasoline.
No, they definitely can't do any of that.
Right. So if this inflation is primarily being driven by a global energy crunch from a geopolitical conflict, how does raising domestic interest rates in the U.S. actually fix the price of gas or energy? The Fed can't print oil.
That's a very valid pushback.
So that leaves them with only one lever, which is demand. Are they intentionally hurting the domestic economy to cool off global prices?
Yeah, the blunt reality of monetary policy is that when supply is constrained, the only way to prevent prices from spiraling is to aggressively suppress demand. I mean, if energy is scarce, but consumer spending habits remain unchanged, prices will inevitably skyrocket.
So they have to break the spending habits.
Exactly. The Fed's only recourse is to make borrowing capital so expensive that businesses cancel factory expansions, companies freeze hiring, and consumers pull back on discretionary spending. By artificially inducing a slowdown across the broader economy, they reduce the aggregate demand for that constrained energy supply.
I see. They can't build more houses or pump more oil, so they have to make the cost of borrowing so painful that we basically voluntarily take ourselves out of the bidding war.
That is the exact dynamic. They are using blunt force on the demand side to compensate for an intractable geopolitical crisis on the supply side. And that blunt force operates through a very specific set of financial plumbing.
Let's trace that plumbing, actually, because the ripple effect hits your wallet, the listener's wallet, directly.
Oh, absolutely.
With the Fed funds rate sitting where it is, and with the threat of another hike looming, the spread between the wholesale cost of money and the retail cost of money is creating immediate pressure. The prime rate, which banks offer to their top-tier corporate clients, moves in lockstep with the Fed funds rate.
Right.
And everything else, personal bank loans, auto loans, variable rate credit cards, is built on top of that prime rate.
Yeah, the prime rate is the foundation.
So essentially, the Fed funds rate is the wholesale price of money. When the wholesale cost goes up for banks, they pass that cost directly to us at the retail level. So our credit cards and mortgages get more expensive.
The impact on variable debt is immediate, definitely. But the ripple effect on long-term fixed debt, specifically the housing market, is
Yeah.
where expectation management truly shows its teeth. I mean, the Federal Reserve does not actually set mortgage rates.
Right, a lot of people don't realize that.
Yeah, mortgage rates are largely dictated by the yield on 10-year U.S. Treasury bonds.
And here is where that 85% probability of a future rate hike from the FedWatch tool actually materializes in the real world.
Exactly. Banks look at 10-year Treasuries as the risk-free baseline for long-term lending. If the U.S. government is suddenly paying a 4.5% yield on a perfectly safe bond just because bond traders expect the Fed to keep rates higher for longer, well, a bank's calculus changes instantly.
They want their cut.
Oh, yeah. They are not going to lend money to a home buyer for 30 years unless they can charge a significant premium over that 4.5% baseline to compensate for the risk of default and prepayment. So as Treasury yields rise based on the mere expectation of Fed hikes, banks automatically push up the interest rates on 30-year fixed mortgages to maintain their required profit spread.
So the credible threat of a hike tomorrow makes a 30-year mortgage more expensive today. The market just does the Fed's tightening for them.
Yep. And if we connect this to the bigger picture, the Federal Reserve is fully aware of the collateral damage this strategy inflicts. Putting downward pressure on 3.6% entrenched inflation requires slowing economic growth. It means intentionally cooling down the labor market.
Wow, that is a heavy trade-off.
It is the greater evil they are fighting. They're actively choosing to risk higher unemployment and a sluggish economy because entrenched inflation is a systemic cancer. It relentlessly destroys the purchasing power of every dollar in circulation. A slowing economy is painful, sure, but a society where the currency loses its value structurally is devastating.
Okay, here's where it gets really interesting. And frankly, it's the most shocking piece of evidence in these sources.
Yeah, this part is wild.
Since 1977, the Federal Reserve has operated under a dual mandate from Congress, which is to maintain price stability and maximize employment. They are legally obligated to balance both.
That's their job description, basically.
Right. And in previous FOMC statements, they always included boilerplate language acknowledging their duty to keep the labor market strong.
Yeah.
But in the policy statement explaining this new rate decision, that language was entirely removed. They effectively cropped half of their job description out of a public statement.
Omitting the employment mandate from official communications is an incredibly stark maneuver. It's really the central banking equivalent of slamming your fist on the table.
Yeah, looking at analyst Robbins' note in our materials, he explicitly calls out this decisive language shift. He argues it was a calculated move to shore up the Fed's inflation-fighting credibility.
Which makes sense, given they didn't raise rates.
Exactly. Robbins notes that because they didn't actually raise rates at this meeting, they needed to project absolute, uncompromising strength to the financial markets to prevent bond yields from dropping. So the statement simply read, "The committee will deliver price stability, period."
And the psychology of the market demands that level of theater. Financial markets are acutely aware of the dual mandate. Traders know that historically, central banks get weak knees when unemployment starts to rise.
Right. Nobody wants to be the one causing massive job losses.
Exactly. So if the Fed projects any hesitation, the market might assume the central bank is bluffing about keeping rates high. And if the market thinks the Fed is bluffing, the threat loses all its power. Bond yields drop, mortgage rates loosen, and the economy speeds back up, fueling even more inflation.
So the market calls the bluff and the expectation management completely unravels.
Precisely. By stripping out the employment language entirely, the Kevin Warshie administration is basically looking the market dead in the eye and signaling that they are not bluffing. They are communicating that they will tolerate significant job losses if that is what it takes to break the 3.6% inflation trend. They are trying to do the heavy lifting of an actual rate hike using only aggressive rhetoric.
Wow. To pull all of this together, the Kevin Warsh era has officially begun with a distinctly tough-talking pause. Actual interest rates didn't move a single basis point today.
Not one.
But with inflation projected at 3.6%, driven by an energy crunch in the Middle East that the Fed cannot fix, they are aggressively signaling that the current environment is temporary. Higher borrowing costs for credit cards, auto loans, and mortgages are being priced into the system right now, well before the end of 2026. The omission of the employment mandate makes it crystal clear they are prioritizing price stability above all else, even employment.
The line in the sand has been drawn, and they are really leveraging their institutional credibility to enforce it.
So what does this all mean for you? It is time to look at your own exposure. Examine any variable rate debt you are carrying, things that will automatically get more expensive as the prime rate adjusts to these expectations. If you are planning a major purchase that requires financing, particularly real estate, you need to factor in this new baseline.
Yeah, be careful out there.
The window for cheaper borrowing isn't just closing, it is being actively slammed shut by market expectations. Do not get lulled into a false sense of security just because the headline rate stayed flat today.
This does raise an important question, though, and it's something for you to really mull over. It will define the financial landscape over the next 12 months.
Right.
The Fed is currently managing a multi-trillion-dollar economy through tough talk and the mere threat of future hikes. They are spending their credibility to keep the market tight without having to inflict the systemic shock of an actual rate increase today. But what happens if we reach the end of 2026, the global energy crunch is still keeping inflation elevated, and the Fed still hasn't actually raised rates?
Oh, wow.
Yeah. How long can a central bank control the global bond market with threats before the market stops believing him entirely and just calls the bluff?
It is the ultimate staring contest. They created massive turbulence today by doing absolutely nothing. The real question is whether they have the nerve to pull the trigger when the words finally stop working.